Hello everyone, welcome to Quadratic Question. In today's special session, we discuss oil, ocean and opportunity, decoding Hormuz crisis. Markets usually react to numbers, inflation, interest rates and earnings. But occasionally, history interrupts finance. Today, we discuss one such event, the Hormuz crisis, more importantly, what it teaches investors. Is this merely about oil prices or this is a story about global access, supply chain, inflation and long-term portfolio construction? To help us decode this, I have joined Mr. K V Ramaswamy, Director Quadratic Financial. Welcome, sir.
Welcome, Shreekant. Thank you. Happy to be here.
Thank you, sir. We have our first question, that is, let's begin with the period before the crisis. Market looks relatively stable. What were investors missing?
Before the Hormuz crisis hit, the markets were efficient. The situation across the world was stable. Oil was flowing. GDP was growing. Things were very normal. But normally, when everything is normal, is when the disruption starts. And when the disruption starts, it generally doesn't give you time to react, and therefore, that is the opportunity.
So you mean to say essentially stability itself became a risk?
Yes.
So my next question is, what second order effects started appearing?
The second order effects were once the war broke out or the skirmish broke out and traffic through the Hormuz reduced or came to zero, you found that oil, LPG, the supply of all that, all the commodities, phosphates, phosphorus, so many events, fertilizer requirements, raw materials which were used for fertilizer, etc., were all stopped at the Hormuz, this one. And Hormuz had 20% of the overall transportation globally.
Yeah.
And therefore, the whole economics of transportation, costs went up dramatically, supply chains got disrupted, and therefore economies had to face a lot of problems in terms of supply disruptions.
Yep. So investor wanted to test portfolios before such an event. So what should they have checked?
So the testing is of three phases. One is the variables that affect a portfolio or when you build a portfolio. One is quality.
Yep.
You have to have high quality in your portfolio.
Correct.
Number two, your time horizon should be adequate.
Yep.
If your time horizon is too short, then you have a problem. If your time horizon is long, then you will tend not to react. So you have to know your time horizon and then plan accordingly.
Yep.
And the third variable is very obviously the earnings that will happen once this disruption is over. So these three factors will ensure that portfolios will react, it will come down and then it will go up after the event. So clients need to understand these three variables very clearly.
So you think investors often misunderstand hedging?
Yes, because most of the time hedging is in the nature of insurance. So most of the people think hedging is actually leveraging or having an opposite position. It is not. Leveraging is always a danger. So when you do hedging, you must ensure that your quality is intact. Your stock overlaps are in place. Your time horizons are in line with your investments. And once all this is in place, then your hedging will be more fruitful.
Yeah. So for investors, the discussion what we had, so based on that, the lesson before for us is black swan events are may not be predictable, but choke point risks are visible if we are willing to look. Correct, sir?
Absolutely, correct.
So now let's move into the crisis phase. So once disruption begins, what changes first?
When events like these happen, they are generally unpredictable. And therefore, what happens is you will have headlines everywhere, the social media will buzz with negative news, everybody will say negative things, and therefore there is a mahal of negativity across the globe. and that generally has a bad effect on the markets and markets come down. Unfortunately, that is an opportunity instead of which clients or investors exit the market at that point of time out of emotion called fear.
Yes.
Unfortunately, that fear is something that should be replaced by optimism when these events happen. So these are opportunities which are being given by the markets to enter.
And what is the second order effects after this?
The second order effects generally are GDP related. They are related to cost of transportation. They are related to the balance sheet, the profit and loss account of companies, because margins go down and therefore PAT goes down and therefore the multiples go up and valuations become expensive, and therefore markets typically will price in this and give a correction, and that correction is to be bought in where you buy quality for the time that you are decided to buy and stick to your goals.
Correct. Understand. So now let me ask what every investor wants to know. What should investor avoid doing during such period?
Very important question, Shreekant. In such events, normally people panic because of the negativity all around, and therefore they say, what will happen, we don't know, arey kya hoga, things like that. But my advice is, and having seen markets for 40 years and 8-9 cycles of markets, I've always seen that markets, when they fall, they are generally an opportunity to invest.
Right.
If you are invested in quality, as I said, those 3 variables that we have mentioned earlier,
Right.
remaining invested is the best policy. Exiting is not the right thing. Generally, investors panic and exit, which is not the right thing to do. Remain invested and ensure that your portfolio is stable, and if you can add more so that you get the effect of averaging and then compounding after the event is over, because typically once the event is over in 6 months, 1 year or 1.5 years, we have seen that the hockey stick comes out and the market then goes up big time, and you would miss out typically on that upside.
So, and this is what professionals typically focus on?
Yes, professionals also do additionally one thing, that they slow down their investments when they see markets falling, so that they can extend the money over a longer period of time. And that is exactly the game that they play, and therefore they play the averaging first when the event is on, and once the event is over, compounding begins to take shape. Yeah. So you try to use the law of compounding and law of averaging to your benefit. That is what I would recommend.
So the conclusion is, in difficult times, survival comes before the outperformance.
Absolutely. Because without survival of the portfolio, you are not going to be able to take the benefit when the benefit comes in after the event. So the hockey stick is generally a problem, because people exit at the bottom because of fear, and they enter at the top because of greed. I think the emotion should be reversed, and you must take advantage when the markets are giving you a valuation break.
I understand. And after such events ends, market usually recovers. But do you think the system will also go back to normal?
I don't think the system will ever go back to normal, because there will be some permanent changes and there will be some temporary changes. But the permanent changes will be that people's psyche will become a little affected, supply chains will be disrupted for a slightly longer time, cost of transportation will actually go up, and margins will be under pressure for some time. But the fact of the matter is, it is at these times that good managements actually shine out, and they come out and start improving margins and getting higher market share, and therefore their valuations will actually go up in the next foreseeable future. So ideally, in a span of 5 years, normally these events will take up half of the period, which is about 2.5 years. But the balance 2.5 years would be one of either consolidation or an up move, and that up move is where you will find majority of the gains being made. I'll just give you a statistic. If you take the last 20 years, it is approximately 7,500 days. Out of that 7,500 days, you will see the markets are positive only about 500 days. And in those 500 days, if you take out only about 50 days, are actually more than 2%.
Correct.
So effectively, you are trying to time the market is actually a fallacy.
Correct.
So don't try to time the market. Remain invested.
Yes.
Remain in the market rather than trying to time the market.
So the data also suggests that those who are doing SIPs, after when they cross 10 years, the probability of negative return goes up to 0. Is that right?
Yes, it actually happens around the 5th to the 7th year, because we have done last 25 years of analysis, and we found that if your fund is a quality fund and it is in line with your time horizon and you've taken a quality fund manager in terms of the fund, 5 to 7 years should be enough to ensure that you don't lose money.
Yep.
Now, what we have seen is most of the returns are at least higher than inflation,
Yeah.
and closer to the nominal GDP, which is inflation plus GDP growth. And beyond 10 years, the returns are actually much higher than even nominal GDP. And therefore, what I suggest is, whether you are investing in equity or whether you are investing in through directly or indirectly, the longer term perspective is more relevant because it adds huge value to the portfolio.
Correct. So what structural shift could investor potentially watch for from this event going on?
The structural shift is that there will be some events like AI which will change the way business is done. Employments will undergo a massive change, because there will be the coders which will become an extinct species, and you will find people who have higher skill sets getting employed and getting higher wages. The other impact will be GDP will actually bounce back. Across the globe, what we have seen now is that, for example, in India, we have seen that the mid caps and the small caps have actually bounced in terms of earnings.
Yes.
The small caps and the mid caps have actually shown an earnings which is in excess of 40%. And the large cap have still not turned. But if you take the top 500 stocks, if your investment has been in the spectrum of market cap of large cap, mid cap and small cap, in high quality funds or high quality stocks, I think the returns will come back.
Right. So if an investor thinking about long term, how should they think about their portfolios?
When you build a portfolio, what we have already said, the three variables, which is portfolio quality, the time horizon and the earnings, have to be taken into account. But there is one important thing that I believe investors must observe, and that is patience. Because instant gratification is generally a problem. Delayed gratification is generally very, very profitable.
Correct. So what is your advice for the investor who started investing their journey after COVID?
So in COVID, what happened was you had a 40+% fall because of disruptions in the entire society. After COVID, those who came in experienced a 3-year uninterrupted bull market, which ended in August, September 2024. From 21 to 24, they saw uninterrupted bull run, and they thought that they know how the market will work and it's very easy to make money and so on and so forth. Unfortunately, from August, September 2024 onwards, we saw the markets coming down, and for the last 18 months or 20 months till date, the markets have been down. They have not gone to a new high. And we believe we are at the end of that period, maybe another 3 months or 6 months, and we believe that the hockey stick will come through.
Yep.
And therefore, investors must understand that markets are not a one-way street.
Correct.
There will be times when it is up, there will be times when it is down. So you have to learn to average first and then compound later. The averaging takes about 3 years for you to average, whether it's a stock portfolio or whether it's a mutual fund portfolio or other portfolios. After 3 years, the compounding begins. So people wonder, "Arey, we did it for 1 year, now we are having a negative return. Have I did the right thing?" I think that thinking is wrong. You must do whatever you do, averaging for 3 years. Once you've done your averaging for 3 years, you will find that you are generally above the market levels. And the next 3 years, you will find that you have got back your returns, which is over nominal GDP. And therefore, when you get returns in excess of nominal GDP, you must be very, very happy with the results.
Thank you, Ramaswamy ji, for joining us. Those are powerful insights.
Thank you, Shreekant, for having me here.
In today's discussion, we have learned that markets or investing is not only about forecasting interest rates and earnings, it is also understanding geography. Thank you everyone who joined us. Stay informed, disciplined, and remember markets react to events, but long term investors prepare for them. See you soon for our upcoming series of Quadratic Quotient. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.